Have you ever heard the news that the Federal Reserve cut interest rates and wondered what it actually means for you and your wallet? Let's break it down in simple terms. The Federal Reserve, or the Fed, is basically the central bank of the United States. One of its most powerful tools is controlling short-term interest rates. Think of it as a lever to either speed up or slow down the economy. When the Fed cuts rates, it's like hitting the gas pedal. So how does this work? When the Fed cuts interest rates, it becomes cheaper for banks to borrow money from each other. And when banks save money, they often pass the savings on to us, their customers. This encourages people and businesses to spend and invest more, which is especially important during an economic slowdown. Let's start with the most direct impact, borrowing costs. If you have any debt with a variable interest rate, a Fed rate cut is great news. This includes many credit cards, personal loans, and some auto loans. Your interest charges could go down, which means lower monthly payments. This frees up your cash and can relieve some financial pressure. However, if you have a fixed rate loan like a 30-year mortgage, your rate won't change unless you decide to refinance. Speaking of mortgages, this is where rate cuts get really interesting. A Fed rate cut often leads to lower mortgage rates. For new home buyers, this means they might be able to afford a more expensive house or just have a lower monthly payment. For current homeowners, it's a golden opportunity to refinance their existing mortgage to a lower rate, potentially saving thousands of dollars over the life of the loan. The downside? Cheaper mortgages can increase demand for homes, which can sometimes push housing prices up. Now, while borrowers are celebrating, savers might not be so happy. A rate cut is a double-edged sword. When interest rates go down, the returns on your savings also drop. You'll earn less interest on your regular savings accounts, certificates of deposit, or CDs and money market funds. For anyone who relies on interest income, like retirees, this can mean a noticeable drop in their earnings. This often pushes people to look for better returns elsewhere, like in the stock market. And that brings us to the stock market. How does it react? Generally, quite positively. Lower interest rates mean it's cheaper for companies to borrow money for expansion, hiring new employees, or launching new projects. This can lead to higher corporate profits and boosts investor confidence. Historically, we often see the stock market rally after a rate cut, but of course it always depends on the bigger economic picture. Finally, let's talk about inflation and your everyday cost of living. When borrowing is cheap, people and businesses spend more. This increased demand for goods and services can sometimes outpace supply, causing prices to rise. This is inflation. You might notice it at the grocery store, the gas pump, or even in your rent. Over time, inflation reduces your purchasing power, meaning each dollar you have buys a little bit less. So to sum it all up, a Fed rate cut isn't universally good or bad. It creates winners and losers. Borrowers usually benefit from cheaper debt. Savers, on the other hand, earn less on their cash. Investors might find new opportunities in the stock market, and everyone might see the cost of living gradually increase. Understanding how these pieces fit together is key to making smart financial decisions. By knowing what a rate cut means for your loans, your savings, and your investments, you can adjust your strategy and navigate the economic landscape with confidence. If you enjoy clear, simple explanations of finance and economic trends like this, make sure to subscribe for more insights. And if you found this video helpful, hit that like button to support the channel. Thanks for watching.